Every great city tells you a beautiful story about how it was built: trade, ingenuity, hard work, a plucky people pulling themselves upward through discipline and intelligence. London likes to tell that story too. The city of Shakespeare, of Parliament, of rule of law, the birthplace of liberal democracy and polite bankers in tailored suits who seem far removed from anything as crude as conquest. But under the glass towers and quiet marble lobbies, there's another foundation, a different story, one that does not fit neatly into tourist brochures or commemorative plaques. At the turn of the 20th century, Britain fought a brutal war in a distant corner of Africa. Farms were burned, livestock slaughtered, towns emptied. Civilians, including women and children, were rounded up into camps where disease and malnutrition did what bullets did not. Tens of thousands died. And behind it all, beneath the dust and the smoke and the official speeches, lay the glittering metal that would help transform London into the unquestioned financial heart of the world. Gold, South African gold. The name of that war is mostly a footnote in school textbooks: the Second Boer War, a regional conflict supposedly about rights, governance, and the treatment of British subjects abroad. A historical episode filled between more familiar chapters like Victoria's reign in the First World War. But its consequences did not stay in South Africa. They live inside your savings account, your government's debt, the bond markets that still feed through the arteries of the City of London today. Because the real question isn't just, why did Britain fight the Boers? That's the shallow version. The real question is, how much of London was built on gold taken from somewhere else? How much of the modern bond system, the yields and spreads and auctions we treat as neutral, is resting on foundations laid in wars of extraction and control? This is where money, power, and history collide, and nothing is ever as simple as it looks. Gold isn't just a shiny metal. It isn't just jewelry or coins. It is trust made physically. For centuries, it underpinned currencies, empires, and the illusion of stability. At the end of the 19th century, London was not just a capital city. It was the beating financial heart of the world. The British pound was the anchor of global trade, the gold standard was the operating system, and the City of London was the server room humming beneath it all. But servers don't run on faith alone. They need power. They need fuel. For London, a huge part of that fuel came from deep underground, in mines thousands of miles away, owned from London, financed in London, and ultimately used to turn a brutal conflict over a distant landscape into the backbone of a global bond empire. To understand how scorched earth in South Africa turns into slick derivatives desks in Canary Wharf, you have to go back before the war, before the camps and the headlines, back to the discovery that changed everything. In 1886, on a ridge of land in the Transvaal region of South Africa, prospectors hit something enormous: the Witwatersrand Reef. It wasn't a small vein or a few lucky nuggets. It was one of the richest gold deposits ever found on Earth. Almost overnight, a landscape of scattered farms and quiet towns became ground zero for a new kind of gold rush. This wasn't the romantic gold rush of lone prospectors with picks and pans. It was corporate from the beginning. Capital moved first. British and European financiers poured in money. Joint stock mining companies sprang up. Shares began trading. The names of the mining magnates, the Randlords, started appearing not only in Johannesburg, but in London's best clubs and most exclusive drawing rooms. Their fortunes didn't stop at mine shafts. They flowed into newspapers, political donations, and influence. There was only one problem. On paper, the land belonged to someone else. The Transvaal was an independent Boer republic. Its president, Paul Kruger, was not especially eager to hand control of his territory or its future to London-based shareholders and their allies in Whitehall. He saw the mines as part of his people's destiny, not just another asset class on someone else's balance sheet. So you had a perfect imperial tension, a small settler republic sitting on a mountain of gold, a global empire whose financial system ran on gold, and a city of London that could see, in very clear numbers, what this metal could do for the pound, for British bonds, and for the empire's ability to borrow cheaply for as long as it wished. Exploitation was already happening through concessions, mining rights, and capital flows. But history has a pattern. When pressure is high enough, economic influence turns into strategic necessity. Strategic necessity tends to turn into war. By 1899, the tension between the British Empire and the Boer republics exploded into full-scale conflict. Officially, it wasn't about gold. Officially, it was about the rights of British immigrants in the Transvaal, about stability, about civilization, about defending the empire's honor. Unofficially, it was about control. Control of one of the most strategically important resources of the age, located in a territory governed by people who did not fully answer to London. The Second Boer War was not clean, not surgical, and not noble. The British deployed scorched earth tactics on a massive scale. Farmhouses were burned, crops destroyed, livestock confiscated. The countryside was deliberately stripped of the ability to sustain resistance. Tens of thousands of Boer civilians, many of them women and children, were herded into concentration camps. Disease and malnutrition tore through those camps far faster than rifle fire ever could. African populations caught between the Boer republics and the British Empire suffered immensely in ways that rarely make it into the popular memory of the war. Why such intensity? Why such ruthlessness over what looks like, on a map, a smaller, distant territory? Because this wasn't just a question of local boundaries. It was a balance sheet war. Whoever controlled the gold of the Transvaal controlled a key pillar of the global monetary system. For an empire addicted to cheap borrowing, and a city addicted to underwriting that borrowing and reselling it as safe paper to investors around the world, that was non-negotiable. The war ended in 1902 with British victory. The Boer republics were brought under Imperial rule. A political settlement was signed, with language about reconciliation and reconstruction. On the surface, it looked like the end of a chapter. Under the surface, it was something else, a transfer, a redirection of future gold flows, of legal authority, of strategic leverage toward London. When the speeches fade and the soldiers go home, the mines keep working. The ore does not care who drew the latest border lines. South African gold production surged in the early 20th century. Much of that gold, directly or indirectly, found its way to London. Not into the pockets of the men who worked underground, not into the homesteads that had been rebuilt, but into the vaults of the Bank of England, the books of merchant banks, and the confidence game that underpinned sterling's role as a world currency. Gold doesn't have to move in endless shiploads to move power. If London controls the companies mining the gold, the banks financing the expansion, the shipping arrangements, and the markets where that gold is traded, pledged, or stored, then London controls the financial meaning of that gold. The metal becomes more than metal. It becomes collateral. It becomes the physical reassurance behind a story, that the pound is sound, that British debt is safe, that when London promises to pay, it can. The British pound, at the height of the gold standard, didn't just rest on bullion stored in a single vault. It rested on an imperial ecosystem of extraction and control. Mines in South Africa, deposits in Australia, flows from colonies and dominions structured to funnel resources toward financial centers. The city of London sat at the center of a spider's web, and gold was one of the strands that made that web strong enough to hold the weight of an empire. Here's the quiet trick that often goes unnoticed. The real profit was rarely in the gold itself. Gold was heavy, inert, and expensive to move. The real profit was in the promises that gold allowed. Government bonds, railway bonds, colonial development loans, war financing, IOUs printed on paper, priced in sterling, and traded in the city for commissions, fees, and spreads. The story was simple. This paper is safe because it is backed, somewhere in the background, by real gold. The more gold that sat, or was believed to sit, behind the pound, the more plausible that story became. Notice where the violence enters the ledger. Burned farms, empty homesteads, dead children in camps. None of that appears on the balance sheet. What appears is an increase in reserves, an improvement in confidence, and a strengthening of London's position as a lender to the world. When a government in Latin America, or a railway syndicate in Asia, or a dominion-seeking infrastructure funds went to borrow, they paid an interest rate that reflected London's perceived safety. The security of investors in British bonds, and often in British Empire-backed projects, rested in part on a monetary regime shored up by resource control won through wars like the Boer War. But the illusion of permanent stability never lasts forever. The First World War smashed through the old assumptions with industrial violence. Even an empire with vast gold reserves could not fight a global war for years without breaking something fundamental. To pay for shells, ships, and soldiers, governments issued debt on a scale humanity had never seen. The gold standard bent, then snapped. Britain suspended gold convertibility. The story that every pound was as good as gold no longer matched reality. After 1918, there was a frantic attempt to rewind the clock, to return to gold, to pretend that the old world could be patched back together if the right parities were restored and the right policies followed. The attempt failed. The mathematics of war debts, reparations, and deflationary policy were too unforgiving. By the 1930s, countries were abandoning gold one after another. Currencies were devalued. The Great Depression exposed the cracks in a system that had tried to anchor itself to a metal while floating in an ocean of new paper promises. Yet London did not vanish into irrelevance. It did something more subtle and, in the long run, more powerful. It changed costumes. The city shed its role as the unquestioned gold-backed center of the monetary universe and reinvented itself as a flexible, creative dealer in credit and currency. The stage changed from fixed gold parities to managed exchange rates and eventually floating currencies. The actor stayed the same, London as a central node in the trade of IOUs. Gold did not disappear. It still mattered as a reserve asset, as a psychological anchor, as a hedge, but it stopped being the star of the show. Behind the curtain, the logic remained intact. You take what the world trusts, gold, pounds, and later dollars, and you use that trust as collateral. On top of that collateral, you build a structure of loans, bonds, and financial products. You skim your percentage on every layer: underwriting, trading, advisory, custody. After the Second World War, the stage was rearranged again. Bretton Woods put the US dollar at the center, backed on paper by gold at a fixed price. Other currencies pegged themselves to the dollar. It looked at first glance like London had lost its crown to New York. The United States held the largest gold reserves. The dollar replaced sterling as the world's formal reserve currency. But history has a habit of rewarding those who understand the game. S rules at a deeper level. London adapted yet again. It became the hub of the Eurodollar market. US dollars held and traded outside the United States, often beyond the direct reach of American regulators. It positioned itself as a global offshore center, a place where capital could move more freely, where regulations could be navigated or avoided, where new instruments could be tested and scaled. When financial markets were deregulated in the 1980s, a period remembered in London as the Big Bang, the city was ready. The old clubby world of gentlemen bankers gave way to a high-speed labyrinth of sovereign debt traders, derivatives desks, and currency specialists. By that time, hardly anyone thought about the Boer War when looking at bond yields on a screen. Gold had become a line item, not a religion. But the deeper pattern hadn't changed. London's specialty was still being the middleman of the world's promises. Resources, whether gold or oil or future tax revenues, lay in one place. The ability to package, price, and move the claims on those resources lay in another. The profits flowed toward the latter. So why does this history matter to you now? Because it exposes something about the way we talk about modern finance. Your pension fund holds government bonds. Your mortgage may be wrapped into a security and traded through one of the great financial centers. Your government issues debt that is evaluated, priced, and traded in markets whose norms were shaped over centuries by empires fighting for the right to be seen as safe. We are told that bond markets are rational, that ratings are objective, that spreads and yields are simply the pure expression of risk and time preference. Look at a modern bond auction, and it appears clean. Numbers, bids, allocations, charts. What you do not see is the history soaked into the word risk. You do not see the wars that helped establish which countries could borrow cheaply forever and which countries must pay a premium for their promises. You do not see the minds that underwrote one currency's reputation while others were dismissed as unstable. This doesn't require conspiracy. Systems don't need villains in smoke-filled rooms to produce uneven outcomes. It requires inertia, memory, and power. When you treat London's modern role in global bond markets as natural and inevitable, you are also, whether you mean to or not, accepting the long shadow of the choices that put London in that role, including a war fought over gold in a place most investors rarely think about. Money is not separate from history. It is history, encoded in numbers instead of narrative. When a former imperial center can still borrow at far lower rates than many ex-colonies, even when their debt burdens or governance may not be dramatically different, you are seeing the fossil imprint of who was allowed to become safe a century ago and who was not. You're seeing how reputations built on resource control, backed by wars and legal systems, still shape investors. Instincts long after the metals have tarnished and the camps have been forgotten by everyone except the descendants of those inside them. We like to imagine that money today is cleaner than it was in the age of empires. We talk about ethical investing, sustainability, responsible capital, but the bedrock of global finance was not poured in clean, transparent conditions. It was poured in wars like the Boer War, in resource frontiers where one side's security meant another side's dispossession, in legal frameworks designed to protect capital more thoroughly than human life. The gold that helped fortify London, standing as the world's dependable banker, did not drift into British vaults on a breeze. It was hacked out of rock by African labor under harsh conditions, overseen by companies structured in London and backed by investors who would never see the mines. It was fought over in a brutal war that turned vast stretches of land into ash and prison camps. That gold strengthened the pound. The pound strengthened the bond markets run out of London. Those bond markets, in turn, allowed Britain and others to borrow on privileged terms for generations. Even when gold retreated from center stage and paper promises multiplied beyond any metal backing, the privileges remained. Today, when a country in the global south approaches international markets and is told it must pay double-digit yields, while another country rooted in older financial centers borrows cheaply, the explanation is not just accounting ratios. It is a memory. It is a hierarchy. It is the long echo of who got to define what safe looks like. When you hear the phrase, the City of London, you might picture sky-reflecting towers, fast-talking traders, screens filled with constant streams of bond yields and currency rates. You might imagine a realm of pure abstraction, where clever people manipulate numbers in ways detached from the physical world. What you should also picture, somewhere in the background, is South African dust, trenches carved into the earth. farmhouses burning under Imperial orders, families in camps, watching children die of diseases that could have been prevented with basic care. Mines plunging deep underground, where generation after generation pulled out metal whose value evaporated into distant ledgers. This is not an argument that you should never save, never invest, never touch a bond. It is a reminder that behind every seemingly neutral financial structure, there is a story, a choice, a set of winners and losers, often decided long before you were born. When you treat modern bond markets as natural, as something that simply emerged from mathematics and efficiency, you are looking at the finished facade and ignoring the scaffolding underneath. The gold that built London is more than a metaphor. It is a chapter written into the global balance sheet. Most of the people who paid for it never saw a stock certificate, never held a gilt, never walked through a banking hall. They paid in land taken, in labor extracted, in children buried. The profits traveled elsewhere. The reputation for safety settled over London like a comfortable fog.